Would it ever make sense to contribute to an IRA only to withdraw the money right out of the IRA just a few days, maybe a few weeks later? It might. I actually just did this for a client, but it doesn't apply in a lot of circumstances. I'll explain the circumstances when it does. That more coming up. Every year when you get your taxes done, you've got to ask yourself 3 questions before you file that return. 3 different questions, okay? So you get your tax return completely filled out, working with your CPA, but before you sign the e-files, before you have them submit the return, or if you're doing your return yourself, you get it all entered, but before you submit your taxes, ask yourself 3 questions. The first one is, do I understand why I got the result that I got? Okay, so do I understand why I got the result that I got? This, whether you're a tax geek or not, this ensures, it's sort of like a double check. It ensures that, all right, yep, I'm getting this deduction and I've got, that income reported. Yep, this, yep. And it's just sort of a double check. And you don't need to be a tax geek to do that, but you first got to ensure that you're filing an accurate tax return, that you're not missing anything. And this double check can really catch a lot of things. So that's one. But then second, then you've got to ask yourself, is there anything that I should be doing right now to improve last year's tax return before I file it? So this is taking a look at, well, are there other deductions that I could be optimizing for? Should I max out my HSA? Should I make an IRA contribution? What about Roth IRA contribution? What about 529 contribution? Are there other changes? SEP IRA contribution? Are there other changes? Are there opportunities for me to improve last year's tax return right now up until April 15 before I file it? That's the second question. And then the third is, what is changing in my tax picture or my financial planning picture that I should update right now to improve my tax return this year? Okay, so right now in the spring of 2026, that's when I'm recording. Yeah, you've got up until April 15 to answer question number 2 to do some things to improve last year's return. But then question number 3 is, well, what's changing for 2026? Okay, that you've got 11 months or 10 months left in the year that you can apply some changes, maybe increase your 401k contributions, maybe shift from pre-tax to Roth or from Roth to pre-tax, something like that, where you've got a lot of room left before the end of the year to make some improvements and enhancements to your tax planning. Well, occasionally, and this doesn't come up all the time, and it doesn't make sense for the majority of folks, but occasionally, when you're answering question number 2, it may make sense to say, oh, let's make a contribution to your IRA for last year, but instead of having it be an investment, a long-term investment, make the contribution for your 2025 tax return, make that IRA contribution for last year, but then just withdraw the dollars this year. And you might say, why would anyone ever do that? And yeah, you have up until April 15 to make that IRA contribution if you're eligible. We'll get to that here in just a second. But that would give you a deduction on your tax return for 2025. But then if you pull the dollars right back out, it would add income to 2026. So why would you do that? Well, in a few circumstances, you might. And I'll tell you, I just did this for a client, and we're early in tax season, so I have no idea how, if this will be the only time I'm helping someone with that this year, or if I'll do it a handful of times. But yeah, it's got to be a creative option that you consider if the circumstances are right. And for them, this was a semi-retired couple who had an adult child, I guess young adult child, okay, was still being claimed on their tax return, but they were eligible. This was their last year, 2025 was their last year to be eligible to receive the lifetime learning credit, okay? So married couple with a child, a dependent child on their tax return who was in graduate school, still in school. And so the husband, he's still working, makes about 160 grand a year, but contributes to his 401k, so it's a little bit lower. And then spouse is semi-retired, so she's working part-time, but together their income is above the threshold in order to get the full lifetime learning credit for married filing jointly. That phase out starts at 160,000 modified adjusted gross income and is completely gone if their modified adjusted gross income is above 180,000. So this is their last year, 2025, their last year to get this tax credit, and they were phased out of it, okay? Because one of them, and in fact both of them, have earned income, that makes them eligible to contribute to an IRA. And he has a retirement plan through work, but she doesn't. Okay, so technically, he wouldn't be able to contribute to his own IRA and deduct it because their income is above those limits to be able to deduct the IRA contribution. But she does not have a retirement plan through work, and therefore she could deduct their contribution because their income is below that threshold. For 2025, that threshold is $236,000 of modified adjusted gross income. Their income well below that. So eligible to make an IRA contribution for her and deduct it for 2025. So in their circumstance, contributing $8,000 to her Roth IRA for last year, they're in the 22% tax bracket. It was going to save them 22% federal taxes, about 5%, 4.25% for state, but it was going to allow them to get some of this lifetime learning tax credit, okay? And then, but this wasn't long-term money. Cash flow was a little tight, and so they said, well, we're not going to invest this for the long term. So then after making the contribution, a week or so goes by, and they'll withdraw the dollars. That's going to mean that $8,000 is taxable in 2026. Well, she's over age 59 and a half, so there won't be a penalty, and they're going to be in the 22% tax bracket this year as well, and the same state tax. So yes, they avoid or they defer, save 22% for last year and 5% state. They're going to pay 22% this year, 5% state. You might say, well, that's a wash. No one would do that, but they were able to get a few $100s of tax credit by doing this. And that's really the primary time where this circumstance would make sense for you to contribute to an IRA, pre-tax IRA for last year, only to withdraw the money right back out if it's not a long-term investment. So being eligible, making yourself more eligible for a tax credit, and I would say the biggie is advanced premium tax credits for if you've got your health insurance through healthcare.gov. While I gave an example of lifetime learning credit, and same may apply for American Opportunity Tax Credit, the big one here is if you get your health insurance through healthcare.gov and you stated that, yeah, my income's going to be at this amount, and therefore all along in 2025, you are paying a reduced premium. Well, it all gets trued up on your tax return when you file your tax return. And if your income turned out to be a little bit higher, making a deductible contribution to your IRA, same with the HSA, by the way, is one of the few things that you can do to reduce your modified adjusted gross income so that you make your income look a little bit lower and either improve your premium tax credits that you get on your tax return or ensure that you're not having to pay too many of them back or any of them back at all. And so if you were on healthcare.gov, had your health insurance through healthcare.gov last year, but this year you're on a group plan, or maybe getting your health insurance through an employer, or maybe for Medicare or something like that, where last year you want to bring your income lower and you don't care as much about what your income is going to be for this year, that'd be a time to make a contribution for last year. And then finally, sort of a third scenario is if last year you are in the 22% tax bracket and this year you know you're going to be in the 12% tax bracket. So making a contribution for last year to reduce the 22% tax bracket and then have the income land in this year when you withdraw it, but maybe you've shifted part-time or you're semi-retired and so that money is really short-term, so you need it back, but when you withdraw it, you're going to only pay tax at the 12% rate. Would it ever make sense to make a contribution during this window between 1/1 of this year and April 15 of this year? Would it make sense to make an IRA contribution for last year when in fact it's not long-term money and you're just going to pull the money right back out a day, a couple days, maybe a week later? It might. It might. You've got to be aware of the circumstances, number one. And number two, you've got to make sure that you're, not going to be penalized when you withdraw the dollars or create some other side effect, okay? That's why, going back to those three questions, you want to understand, well, is my tax return right? Is it accurate? Do I know why I'm getting the result that I've got? But then those other two questions, is there anything I can do now to improve my tax picture? And then what's changing in my tax picture this year that should impact my tax planning? Those two questions can help you identify the couple of times when it may make sense to make a deductible IRA contribution for last year, only to withdraw the dollars this year and have it be taxable in 2026 instead. That type of creative financial planning and tax planning is what you need to be doing with your CFP. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.